Hello and welcome back. Today we are going to jump into chapter 23, which is all about relevant costs for managerial decisions. So let's take a look at some of the procedures and concepts and analytical pieces that we're going to learn about today. So relevant costs, these are the things that are important because they will change the output of a decision that you make. So if I'm going to make a new product. Let's say I have a bakery and I decided I want to get into cheesecakes, which is something I haven't done before. So what kind of costs are going to be important in that decision-making process? Is it going to be the actual ingredients, the extra time, how many new materials maybe it takes? Maybe I have to buy some special pans. So all of those are relevant costs because they will affect that business decision. So we'll be jumping more into that. We are going to use that information in the procedures to help us decide whether we're going to make or buy a product. Sometimes we spend more money on employee benefits and things like that when we could maybe buy the product already. We need to evaluate, sell, or process further decisions. We're going to determine what type of sales mix we should have. Maybe we have multiple products. And so back to the bakery, my cookies are really outperforming my cakes. So do I need to spend more time and energy on the cookies? Segments, maybe we need to eliminate some segments. If those cakes are doing poorly, maybe we get out of the cake business. And evaluate keep or replace decisions, determine selling price for their products, determine if it's beneficial for us to make any special offers to our customers. And then the analytical piece, which is the ratio piece, we're going to be talking about the price of services using time and material pricing. So let's jump into these relevant costs. I already kind of gave you kind of a rundown of what makes it a relevant cost. And so we're going to use this in our decision-making process. And so we're going to define our decision. So in my bakery example, it's like, should we start making cheesecakes? Of course, because they're my favorite. So we're going to define the decision that we want to make for our company. We're going to identify alternative actions. Should I make my own cheesecakes, or should I network with somebody locally who doesn't have their own shop? There's a really cool lady online. Her name's she on Facebook. She goes by the Cheesecake Lady. And I have ordered from her. It's very tasty. And she will actually sell her products in places like the Brown Bag Bistro. You can check out her cheesecakes there. And so, that would be an option for me as well as a company if I had a bakery. So I could do that. I could buy it locally. I could make it myself. I could maybe make a whole different product instead of cheesecakes. And so then we're going to collect that relevant information. What are the costs associated with making that cheesecake? What would be the cost if I worked with the Cheesecake Lady? If I decided that maybe I wanted to get into sourdough bread baking, is that, what kind of market information as well? Not just the cost, but what does the market look like? What are sales currently like? So then after we take all that relevant, collect all that relevant information, we can decide which one's the best avenue. Like, oh, well, it is a lot cheaper if I make it myself. There might be a little learning curve since I haven't made cheesecakes in the past, but I have enough access to information, and the sourdough breads are just not as popular as cheesecakes. So we're going to go ahead and make our own cheesecakes. So we're going to analyze that information once we've selected it, kind of look over it again, make sure that we have a game plan in place. And then we're going to kind of monitor that process and see how we did. Did we make a good decision? So that is your decision-making process. So we come into some terms, and a lot of you have been talking about these terms inside of the discussion board this week. But we've been talking about incremental revenues and incremental costs. So incremental is any additional revenues we're going to earn by adding the cheesecakes, because my revenue is what it currently is, but if I have a change of action, how will that affect my revenues? So any increase or from that activity will be our incremental revenues. Now, incremental costs are the same thing, right? We choose this course of action, but we're going to have additional costs. Like I'm going to have to start buying a lot of cream cheese to make my cheesecakes. So if I decide to go down that way, that would be an example of my incremental costs. And then our incremental income, and this chapter always drives me crazy because by the time I'm done saying incremental, I feel like I'm saying ink, raw mental instead of incremental. It becomes one of those words you say over and over again, and it doesn't make any sense, right? So we would take our incremental revenues minus our incremental costs, and that would give us our income. So it's still revenues minus costs gives us income, but now we're just isolating any of those additional revenues and additional costs from making this new business decision. And so we are going to pick the one that gives us the biggest income. We definitely don't want to waste our time on sourdough bread if it's really not going to give us much in return compared to making cheesecakes. Now, a sunk cost arises from a past decision and it cannot be avoided or changed. They're irrelevant to current and future decisions. This is hard. This is hard for us. We mess this one up all the time in real life. So, give you an example. Let's say I bought tickets to a concert that I was really excited about. And so I've paid for them, I'm planning to go, but before the event actually comes, I have a better offer, right? I have something that's like a once in a lifetime thing. Somebody offers me some free tickets or whatever, or maybe it's just a little bit of money, additional money, but I'm worried about how much I paid for the concert tickets already. Like, oh, I don't want to waste that money. But accounting is saying that's a sunk cost and shouldn't be part of your future decisions. It's a hard one, right? We hate to feel like we're wasting money. So out of pocket requires a future outlay of cash. And so these are going to be relevant. If I have to spend more money based on this decision, I'm going to want to understand how much that is, right? And how that's going to affect me. An opportunity cost is you have all of these different options. So what's your potential benefit that you're going to lose by taking the other decision? So if I'm going back to I'm just going to keep talking about cheesecake and bread all day long. If I decide to go the route of the cheesecake, the opportunity cost is going to be whatever I projected the income to be from the sourdough bread making, right? And so those are going to be very relevant to our decision-making process, or else how could we know that cheesecake is the better way to go unless we saw exactly the difference between one option over the other? Now, an avoidable cost can be eliminated by choosing one alternative versus another. And these are also relevant. So maybe in the sourdough bread baking, I have to buy a whole bunch of special pans in a special oven or things like that. Those are going to be costs that I can avoid if I go down the cheesecake route. Okay, so just a whole lot of different terminology to help you understand costs and which ones are important to look at. So let's put this into practice, right? Let's try this out in our procedures. So we have a make or buy analysis, and we're just going to line up all of the relevant costs. So we currently buy one of the parts that we need for $1.20, but we could make it for $1.05. And we come to that conclusion by breaking down all of our relevant costs here. So we have direct materials specific to making it, direct labor, and then overhead. And we're only going to look at that incremental overhead. If the overhead is going to stay the same no matter what, it's not irrelevant, right? It's not relevant. It is irrelevant. So we're only looking at any incremental amount that's going to change because we're going to make it, and that's 20 cents. So they came down, added that up, and we figure out that it's $1.05. To whereas if we buy it, it is $1.20. So we can save 15 cents. So we're going to want to make it over buy it. We do the same kind of analysis when we evaluate sell or process further decisions. So it's a little bit, a few more steps here, but not too bad. So this is if you think you're a manufacturer and you have several steps in your process. You remember how we talked about companies having various work in processes. So they go from one work in process to the next one until they finally get to the completed product. So this one says that somewhere in that process, in those many processes, it's going to cost us more money to continue processing it, but maybe we would be better off if we sold it partially completed. So we're going to line up all of our relevant costs and then determine how much our revenues would change from one option to the other. And again, it comes down to which one's going to give us the higher net income. So if we sell it as is, we can earn $50,000. And you're like, well, how come there's no costs, right? Because those are sunk costs that it took to get it to this point. So it's not relevant in our decision. It's just like right now I have two options going forward. I can either sell it as it is, or I can process it further. So again, we're looking forward. We're not thinking about the costs that we've incurred in the past. So now if I want to process it further, I'm going to be able to get a lot more revenue from that finished product, but my costs are going to go up. So my additional costs are estimated to be $80,000 in order to process it further. So we can see our net income, if we sell it as it is 50,000 versus if we process it further, it's 70. So even though we have to spend 80,000, we are going to earn $20,000 more. So we're going to want to go ahead and do that because we'll cover those additional $80,000 and we will earn an additional $20,000. All right. Sometimes you make an error, right? Something happens and the product is defective. So now you have to figure out, do I go back and rework it, or do I just scrap it and start over with the new one? So it's going to come down to which one's going to give us the higher net income. Are you sensing a little theme here, right? Like which one is going to give us the most money in our pocket? So they have $4,000 coming in if they scrap it. They maybe take it to a recycling center or something like that. They're going to buy it as scrap for $4,000. But if we take the time to rework it, it's going to cost us $15,000, or it's going to give us $15,000. So we're seeing about a $11,000 increase in revenue and only an additional $8,000 of additional costs. So it's going to give us net income of $3,000. So even though it seems like a lot of time and energy, that time and energy is going to be wrapped up in that cost, right? We're going to track that direct labor costs associated with the rework, as well as any materials that are associated with this. And it is worth it because it's going to give us an incremental $3,000 in income. All right, so how do we determine our sales mixes? So a company sells a variety of products, and not all of them are going to be equally profitable. There's always going to be one that's kind of doing better than all the others. So one of management's role is to figure out which ones and how much they should sell of each of their products, right? So this is great for all of you people who are not becoming an accountants, but are looking at going into business management. These are some of the decisions you might be faced with. And so there's some things that you have to take into consideration. Do you have a limitation in your production floor? Like I can only produce one product or the other, and I only have so much time. So they have to identify the most profitable combination of those sales mix of products. And so we're going to focus on the contribution margin per unit of a scarce resource. It means it's limited. So I have a limited hour in the day, right? Limited number of hours in the day, a limited amount of space, a limited amount of employees. So we have a lot of scarce resources. So this company sells 2 models of scooters, and it uses the same piece of machinery to create these two models of scooters. So if I'm looking at the product contribution margin, I sell the Pro at 500 and I sell the Max at 750. My variable costs are 350 for the Pro, 550 for the Max. So my contribution margin is 150 for the Pro and 100 for the Max. Now we're going to take this a step further. Now we need to understand the machine hours per unit. This is our scarce resource, right? Either we're using it to create this product or that product. And so it only takes 1 hour to create the Pro, whereas it takes 2 hours to create the Max. So if I look at like how much am I earning in time, I'm earning $150 contribution margin per machine hour for the Pro, whereas I'm only earning $100 per machine hour for the Max. So it tells me I should probably be focusing in on the Pro versus the Max, right? And so we need to sell as many of those as we can, but it's not like we should eliminate the Max because we need to consider market demand. Now, if the market is demanding more than you can produce, then absolutely you should focus in on the Pro and forget the Max. So you want to go and produce as much as the market will demand. So if we're looking at unlimited demand, we would again want to focus in on all the Pro model and none of the Max. And we're going to use the maximum 2,000 machine hours. Now, if they have limited demand, then they're going to just max out whatever the demand is for the Pro. And so they've decided that 1,200 units is as much as the market is going to take. And then they will create the Max. And again, assuming they're not going to create more product than there is demand. And so we're assuming that they have a demand of 400 units for the Max. And so again, we're using up that limited resource, that 2,000 hours of machine hours, and this is how we're breaking it down. And it's going to give us a contribution margin of 220. So I'm going to go back a slide. Not as good as the 300,000, right? But it wouldn't do us any good to make it if we can't sell it. So that's why the demand is important. All right, now what if we want to evaluate segment elimination decisions? Because what we don't understand is, always understand when we look at it, it's like, oh my gosh, this department is losing money, or this product is losing money. But what we don't think about is sometimes they're losing money, but they're helping cover some of that overhead. And some of that overhead doesn't go away just because you get rid of the product. So if it's an avoidable cost, that's great. That's going to be relevant. But if it's unavoidable, those amounts are going to remain whether we get rid of this segment or not. And that means those unavoidable costs have to get sucked up by the other segments that are making money. And it could mean that you're making less money overall. Okay, so let's take a look at how this works. So we have money coming in from treadmill, wellness, and fitness line. These are 3 different segments. We can see our sales, we can see our variable costs, we have our contribution margin, we have our fixed costs, and then we have our income. So gosh, just looking at this information, we're like, whew, we should probably just eliminate the treadmill because they're losing money, right? It seems like a logical approach, but it's not quite so simple. So let's dig into that a little bit more. If we look at the continuing it, if we continue it, we're going to lose $10,000. So we had sales of 40. So if you look here, 40, 35, 5, 15 gives us a loss of 10, right? So that's the same information that's popping up here. Now, if we eliminate it, we're not going to have any more sales. We're not going to have any more variable costs. That means we're not going to have any kind of contribution margin, but there are $11,000 in fixed costs that aren't going to go away. So if we eliminate it, we're actually going to lose an additional $1,000. So it makes sense to continue producing the treadmills. And so if we look at it in total, you can see there, if we eliminate it, we're have income of 94,000. But let's go back. See, they had a total, their net income was 95,000 with all three segments. So, you know, the big takeaway here is some of those costs might not go away if you eliminate the segment, and then the other segments have to pick that up, and it can bring down overall income. All right, the fifth procedure that we're learning about is to evaluate keep or replace decisions. So maybe you have this old asset and you have to figure out whether you're going to keep using it or you're going to replace it. And so you're going to have to compare your revenues and your costs associated with keeping that old asset versus replacing it with a new one. You want to replace it if overall income will increase, and you want to keep the asset if overall income decreases with the replacement. And this is a tough rule to follow and a tough thing to live with. So let me give you a real life example. I managed at one point in time St. Anthony's Cancer Center. And before they built their new cancer center, the old one had an older linear accelerator, which is the machine that gives people their radiation therapy treatments with cancer. And so it was an older machine. And if we replaced it, it was several millions of dollars, because even the room would need to be restructured because the newer machines put out higher radiation and you'd have to have bigger insulation. And there was just millions and millions of dollars wrapped up in the replacement of this. And so we were continually replacing it, but it was replacing parts, repairing it, not replacing the machine. And it was becoming harder and harder because it was older. So those parts were harder to come by. And so there was always this kind of balance, this push, like, okay, we really need this. We need to keep planning for it, because what's going to happen to our revenue if it goes down and we can't replace it? It's going to drop off, right? It's going to be eliminated. We're going to be out. And it's sometimes hard to get restarted. You're better at keeping your momentum going. People know that you're a good place to go and provides good service. And so word of mouth spreads, good word of mouth spreads, but so doesn't bad word of mouth. So if you have people saying, oh yeah, I couldn't get in there because their machine's down, and you know, so there was all kinds of balance. So this is just a theory, but you have to balance this with real life other decisions. But we're going to kind of go down this road and just kind of go along the lines of theory. So they're considering replacing an existing machine with a new machine. And some machines, especially if you think about factories producing a product, they could be faster. My linear accelerator at the cancer center was still just going to treat one patient for one period of time. We weren't going to do anything faster, right? And so it wasn't going to increase our revenue. So the existing machine has a book value of 20,000 and variable manufacturing costs of 50,000. There's no salvage value, and the selling price is currently $25,000, and they have 5 years left. Now, a new machine will cost $100,000 and has variable manufacturing cost of 36,000. So maybe it needs less supplies in order to run that particular machine, and the useful life is 5 years. So if we keep it, our variable manufacturing costs, if we take 50,000 a year times 5 years, is going to give us that $250,000. So we're looking at it over this 5-year period, to where if we replace it, the sale of the existing machine is, we're going to bring in 25,000, and the new machine is going to cost us 100,000, but our variable manufacturing costs are going to be 36,000 times 5 years. So we're going to save on that. So when we add it up, keep or replace, gosh, we're going to have an additional decrease of $5,000. So we're going to lose money, additional money, if we replace it right now. Even though you may look at it and say, but we're saving so much money from the variable manufacturing costs. It's still in the theory arena. This is not a good decision. So we need to just keep the machine until this number is either equal to or less than the loss for keeping it. So how do we determine a product selling price? So companies can be a price taker or a price setter. So price takers. There's a lot of strong competition. The product is not unique. It's not branded. There's low barriers of people producing similar products. And so their approach is target pricing, whereas price setters, there's not many competitors in that market. I think of the airline industry. It's not, there are a handful of airline industries. Their product is unique. Their product is very branded, and there are high barriers to entry because it's very expensive. Like I can't just go out and decide that, yes, I'd like to own my own airport. And so oftentimes they figure out whatever the cost is for providing their service, and they add on how much they want to make. So it's known as cost plus pricing. So price takers, they don't have as much control over setting prices because us as consumers are going to go to the cheapest outlet, right? I want the best value that I can get for the smallest amount of money. But price setters have more control, right? They have more control because they don't have so many competitors. They have that unique brand. Some people buy just because of the brand, or fly, like I fly Southwest because I can earn points on my Southwest credit card, and it's typically got the cheaper rates and all of that. So I don't even look at the other airlines like I probably should. Then we have price takers use more target pricing type methods, which we talked about, and price setters use more of the cost price. So to find these cost plus methods, this is again common when you're a price setter, and they will mark up the cost to get the selling price. So they're going to say products plus their selling, administrative, and general costs are going to give us our total cost. And so we're going to take our total cost divided by our expected units to be produced and sold, and that'll tell us what our cost per unit is. And then we can take that times our markup percentage to tell us how much we're going to sell each unit for. And so when we take our total cost plus that markup, that's going to give us our selling price. So those three steps are kind of outlined right here. These are all of their costs. This is their markup. So when they take their cost plus their markup, they find their selling price is going to be $84. So target costing can be used when competition is high. It is expected, they have an expected selling price of $80 in the market, and the company wants to earn a profit of $14. So they're going to have to try to figure out how to reduce their target cost per unit to $66. So they've got to kind of back into it. They're like, okay, the market says I can sell it for 80. I want to make 14. So I'm going to have to figure out a way to scrimp down and save to where it's only costing me $66 to create this product. So we take the target profit plus the fixed costs, and we divide it by our variable costs, and that's going to give us our markup percentage. And then we take our variable cost times that market percentage to get our price per unit. And then our selling price is going to be our variable cost plus our markup price. So you can see here's our markup percentage. Then we're calculating that based on our variable costs, and then we're adding that to the variable cost to get our selling price. All right, special pricing. Sometimes you can receive a special offer at prices lower than normal selling prices. And so those special offers should be based on the effects of the income. So you want to accept the special offer if your overall income increases, and reject it if it decreases. So we have a contribution statement right here. We sell it for $10 a unit. We sell 100,000 units. That's 100,000 total. There are individual product variable costs and a fixed overhead, and they've done it per unit for 100,000 units. So we get $2 of income and 200,000 total. Now they're trying to figure out if they should accept an offer to earn an additional income of 18,000. So that $18,000 comes from selling 10,000 units at $8.50. And there are all of our costs. Our fixed overhead is not going to change, but our fixed general and administrative will. So I'll have income of $1.80. And if I multiply that times my 10,000 units, that's a total of 18,000. So you would want to do that. All right, and then our only analytical topic before we get into our homework problems is going to be to determine the price of services using time and materials pricing. Actually, I think that I am going to go on into the homework real quick. Just one moment. Okay, so let's look at question number 1. We have Beto company pays $2.70 per unit to buy a part for one of its product it manufactures. With excess capacity, the company is considering making the part. So making the part would cost $1.50 per unit for direct materials. So I'm going to go ahead and pop that in here because if I make it, it's going to cost me $1.50 for direct materials and $1 per unit for direct labor. And the company normally applies overhead at a predetermined rate of 200% of direct labor cost. Incremental overhead to make the product would be 80% of direct labor. So that's only what we're worried about. So it's going to be equals 80% of the direct labor. So $1 times 0.8. And so this one we're not buying, so we're skipping that line. And then we're just going to add up all of the costs. So it's going to cost me $1.30 to make it, right? And then to buy it, it would be $2.70 per unit to buy the part. So the cost difference, if I take my cost difference of equals the $3.30 minus the $2.70, it's going to cost me an extra 60 cents to make it. So I should buy it. That is my make or buy decision. Okay, moving on to question 2. We have Kobe Company has manufactured 265 partially finished cabinets at a cost of $66,250. These can be sold as is for $79,500. Instead, the cabinets can be stained and fitted with hardware to make finished cabinets, but further processing would cost $15,900. But the finished cabinets could be sold for $106,000. So we're going to figure out what's best here. So if I did nothing else, my revenue would be $79,500. There are no additional costs associated with this because any prior costs are sunk costs and are not relevant. And if I process them further, I'll be able to sell them for $106,000. But I'll have to put in an additional $15,900. So if I subtract the revenue or the cost from the revenue, I find that I would have income of $90,000. So my incremental income would be this $90,000 minus the $79,500, $10,600. So I should definitely process that further because I'm going to have a bigger net income. All right, let's move on to number 3. A company must decide between scrapping or reworking units that do not pass inspection. The company has 19,000 defective units that have already cost them $132,000 to manufacture. Again, that's not going to be a relevant cost for us to worry about, even though it feels like it should be. The units can be sold as scrap for $62,700 or reworked for $91,200, but then they're going to be able to sell them for $174,800. So my revenue, if I'm scrap them right now, is $62,700. Again, I won't incur any additional costs for scrapping them. If I rework them, I can sell them for $174,800, but it will cost me an additional $91,200. So when I subtract those costs from the revenues, I find that my income is going to be $83,600. So I'm going to make more if I rework them. The incremental difference is $20,900. So I should definitely rework the units. All right, let's move on to 5 and 6. So Suresh Company reports the following segment department income results for the year. So we have 1, 2, 3, 4, 5. It looks like we have 3 of them losing money. So the company plans to eliminate departments that have sales less than avoidable cost. So this is my sales. And if it's less than the avoidable cost, they're trying to figure out what they should eliminate. So my sales are more than avoidable here, less than here. So M I'm going to keep, but N I'm going to eliminate. O, there's my sales, and they're greater than my avoidables, so I'm going to keep that. And department P, here's my sales, and my avoidable is less than that, so I'm going to keep that department. And then department T, my sales are 35,000 and my avoidable are 44, so I'm going to eliminate. It says compute the total increase in income if the department was sales less than avoidable costs and identified in part A are eliminated. So I'm going to add up all of the income in the departments that we keep, and then I'm going to subtract the unavoidables from N and T, the ones that we're going to eliminate, because again, they're unavoidable. So even if we close it, we're still going to have those costs. So here we go. I have equals M I'm keeping, so it's 6,100. N I'm getting rid of, but I'm going to still incur 16,800. So I'm going to subtract 16,800. O I'm keeping, so I'm going to add in that 39,100. P I'm keeping, so I'm going to subtract the 6,600 because it's a loss. And T I'm eliminating, so I want to subtract those unavoidables, 14,700. And so I will have that amount as is going to be my income. And so my increase, if I subtract it from a negative number, right? So we can do a parentheses negative 2,600. I'm going to have a $9,700 increase. All right, hold on just one moment. Okay, it's funny, I'm pausing as I record this as I'm helping a student with the exact same problem right now. Okay, so we're going to move on to number 6. So Lopez is considering replacing one of its old manufacturing machines. The old machine has a book value of 47,000 and a remaining useful life of 4 years, and it can be sold now for 57,000. The variable manufacturing costs are 44,000 a year for this old machine. Information on 2 alternative replacement machine follows. The expected useful life for each replacement machine is 5 years. So we're looking at, there's a little bit of a, if we keep it, we're going to have an increase in our, we won't have any additional money coming in from the sales. We won't have any costs going out for the purchase of a new machine, but we will have those variable manufacturing. And so we're going to take that times the 4 years. The old machine has a book value of remaining $44,000 a year. So we're going to take this equals 44 times the 4 years that it can still run. Now, if I replace it, I'm going to get money. It can be sold now for $57,000. And then this is looking at machine A. The purchase price is going to be an outflow, so I'm going to represent that with a negative 116,000. And then my variable cost per year is going to be a negative as well. And it's going to be a negative 22,000 times 4 years. So, and this one should have been a negative as well. Sorry about that. It's an outflow. And so if we sum these together, and then we also sum all these together, then we can find our difference. So if we replace it, we're going to lose 147, but if we just keep it, we're going to lose 176. So we'll gain $29,000 from just replacing the machine. Now we're going to compute that increase or decrease if we decide to go with machine B. So if we keep it, again, it's still a loss of 176,000, which is going to give us a total because those variable manufacturing costs won't change. Now, if we replace it, again, we're still getting the 57,000. But now the new machine is going to cost 129. And the variable costs are going to be 14,000 a year times 4 years. So if I add all those together, it looks like I only lose 128. So my difference is I'm going to increase, my income is going to increase by 48,000. So that's better than the 29,000. So we need to replace the old machine, and we need to do so with machine B. Okay. Number 7. Skull Company makes snowboards and uses the total cost method in setting the product price. Its cost for producing 10,500 units as follows, and the company targets a 12.5% markup on total cost. So they have all these variable costs, then they have these fixed costs. And so we want to compute the total cost per unit if 10,500 units are produced. Then we want to compute the dollar makeup. And then we want to compute the selling price. So we can do this a couple of different ways. I'm just going to kind of outline it down here. So if we're looking at the product cost, you could do this 2 ways, but I'm going to just kind of do it this way. If you have a different approach and get you to the same number, it's fine. So we have our direct materials is 101, and I'm going to take that times 10,500 units. And I'm going to go ahead and change this to where it's a little more easier to read. All right, and then we have direct labor, which is going to be 26 times that 10,500 units. And then I'm going to take the overhead, which this part is variable. So again, 21 times 10,500 units. And then my selling, general, and administrative, so SG and A, is going to be $6. $6 times 10,500 units. Let's see. And then we have our overhead that's fixed. Overhead that is fixed is 471,000. And then our SG&A that's fixed is 432. So I'm doing all this just to get a grand total of how much it's going to cost me to produce those 10,500 units. So now I know this is the total cost for 10,500 units. But I kind of want to know the per unit price, right? So to do that, and I'm just going to do it right in the square, I'm going to take that total and I'm going to divide it by 10,500 units. So it's $240 per unit. So when I was saying you could do it other ways, so you already had the per unit price, so you could have just added all these together, and then you could have added these two and divided by 10,500, and that per unit price, you could add it to the sum of these. So you could approach it either way, whatever makes sense to you. Now the markup, they want a 12.5% markup. So we're going to hit the 240 and just take that times 0.125 or 12.5%. So that's $30. And so our selling price is going to be the 240 plus the 30. So we're going to have a $270 selling price. All right, moving on to our final question in this chapter. Ryo's company makes drones that uses the variable cost method in setting product price. Its costs for producing 31,000 units follow, and the company targets a profit of $311,000. So they have their variable costs, they have their fixed costs, and so we're going to figure out the variable costs, the markup percentage, the markup per unit, and then the selling price. So first, we're going to determine that markup percentage. And so we have, let's see. Yep, we have our target profit. They want to make $311,000 on this. And so then we're going to take out our fixed costs, which are, it's going to be the overhead. And so we have our overhead, our fixed overhead is 681. And then we're going to take our SG&A, which is selling, general, and administrative fixed costs, which are 612. So our target profit plus our fixed costs, because we want to be able to cover those. We're just going to add all of those together. So I'm just going to make a line here. I'm going to hit equals this plus this plus this. All right, so our target is there. Now our variable cost per unit is all of these costs, right? So we have 81 plus 51 plus 36 plus 26. And so we want to, units that we need to produce and sell is 31,000. All right, so if we take these two numbers times each other, we're going to get our total variable costs. So equals this times this. Woohoo! There we go. That looks better. So we have 6,014,000 in variable costs, which is what the first part wants. So you just equals, this is our total variable cost. And then our markup percentage can be found. I'll show you how to do that now. So I'm just going to do it here. And that is going to be taking our target profit plus fixed costs and dividing it by our total variable costs. So we have a markup percentage of 27%. And then our markup per unit, so we're going to take this variable cost per unit, and we're going to times that by our markup percentage. And we're going to change that to a number. So we're going to have, and that number, they're actually wanting us to do the whole number. So it would just be that. And then our selling price per unit is going to be our variable cost per unit plus our markup per unit. So we're going to sell it for $246. So that should take you through all of your homework problems. I'm going to go ahead and just leave this last part for you to review on your own time, the time and material pricing. And other than that, I think that gets you through the rest of chapter 23. We only have one chapter to go and you're done with this course. So congratulations. I'm sure you're getting very excited. As always, if you have any questions, don't hesitate to text me or call me. I appreciate those students who send me pictures of the problems they're working on and ask where they're getting hung up. I think that shows a lot of initiative and responsibility, but gosh, the majority of this class and the majority of online learners I have are very good about getting the things that they need. So pat yourselves on the back. You're almost done. You're doing a great job, and I will see you next time. Bye-bye.